Today we'll be focusing on gap trading. What we're going to look at first is just how straightforward gap trading can be when you follow a clear process. So we're going to talk about gaps, and if you don't know what a price gap is, as a quick definition, it's a space between the candlestick bodies of two separate trading days. What I'll do in a minute is show you a picture of those candlesticks and the gap between the candlesticks. But first, because most people are looking at a chart that you see here, this type of just line chart, you are probably going to be more accustomed to understanding the gap through this type of chart. So if you look at the circle here, we see a price gap, and a price gap simply occurs when you see a disconnection in the trend line. So at the end of Wednesday here, the stock price of Martha Stewart Living was about $3.7, and at the beginning of the next trading day, on Thursday, it rose to about $4.3. Now in between, there's just a gap. Now why is that important? Let's say you owned the stock on Wednesday, and Thursday you open up your broker, your online broker, and you see that, wow, you've made a quick buck for no reason. If you're lucky enough to have done that, congratulations. However, most people cannot predict when a gap will occur, nor can I. My method of gap trading is actually to trade after the gap. The reason is there are some statistical properties of gaps that you can leverage to make a nice, quick, and usually high profit. Like I said, we're going to look at the gap in candlestick form simply because that's the best way to trade gaps. So what you'll see here is another gap, but we're just looking at it in candlestick form. The candlestick just shows you the daily trading range. So if you'll see on the 25th of September, we had a closing price of about $26.5. However, on the next day, the price jumped all the way up to $28. So we have like a $1.5 gap between those two candlesticks. What I mean by trading after the gap is that on the next day or the next couple of days, you look at the stock and you determine whether that stock is going to go up or down. Now I'm going to give you an example of one type of gap called an area gap. You'll see the label area gap here. The area gap is useful because it's a gap that typically closes. In other words, what you'll see is after the gap, the stock price gradually drops to where the gap is no longer a gap. From the top of this candlestick to the bottom of this candlestick, you see that there's no gap between them. What we say is that the gap has filled at this date. Now, I'm not going to discuss all the types of gaps in this presentation. That will be for later. What we're going to look at now is what constitutes an area gap. And generally, it's related to volume. If the volume's not excessively high, we see the volume here is a little bit high, but it's not excessively high, we can usually be pretty certain that the gap is going to close. And that's what happens. The gap fills. Now this is useful because after a gap, the stock is at abnormally high levels. When you short a stock, what you do is you sell it at that level with the promise to buy it back later. So let's say you sold it at about $29 and you bought it back when the gap filled. When the gap filled at about $27, you've made a nice $2 per share. So if you shorted 100 shares of stock, you've made $200. And notice one important thing about these area gaps. They fill rather quickly. This was about a week. So if you had shorted the stock and then bought it back 7 days later, you made a nice $200 per 100 share of stock, which is a very, very, very high ROI for stock trading. And if you do this with options, you could actually make a lot more money. Usually, it's not uncommon to see a ROI of 100% or above when you're trading these area gaps. Now it's important to know that gaps are not an uncommon phenomenon. Gaps occur about 150 times per day. In other words, there's about 150 different stock per day that experience a gap. Some of the gaps go up, some of the gaps go down. A lot of them are these area gaps that you can be pretty confident will fill. If you're just playing these gaps, and you can very feasibly do that, that's all I do. If you just play these gaps, then you have a very specific type of trade you're making, and a very useful type of trade because we have statistics backing it, and we also have a very short time margin on which we can profit, which is useful because we can just keep switching from gap to gap. Here is an example of a gap trade that I made back in September. Now I showed this to my newsletter subscribers, and I'll be showing it to you. This is all right, we'll look at the name of the stock later. It's not really important. You just need to look at what happens. So what we see here is an area gap. Unfortunately, I cut the chart in half so you can't see what happens in the future because we're taking it from my perspective, and at that time I didn't know what would happen in the future, so I'm just trying to show you my way of thinking. We see a low volume at the bottom corresponding to this gap. This gap, if I recall correctly, is about $1 or $2 wide. It looks small here, but it's actually quite big because the stock is trading at high prices. Now the area gap occurred, the volume was low, so I watched this gap for a while and I figured this is going to close. What you do after the gap is you wait. That's step number one. You wait. You make sure that the stock goes up to a price at which you can short successfully for a profit, but you don't short it until you see the stock price starting to fall. So I waited for a more profitable position at the 18th, and I told myself, if on the next trading day the stock begins to fall, I will short the stock and perhaps set a limit order. I actually don't do that because I'm not employed, so I don't need to trust the brokerage to deal with my stock during the day. I can actually watch the stock during the day. So I watch the stock, but if you have a full-time job, your best option is to set a limit order at exactly the top of that candlestick prior to the gap. So what I did was, on the next day, I saw the stock begin to fall. I shorted the stock, and I watched the stock for a while until the gap closed. Now what you see on the next slide is the result. Here's the gap. Here's the day I decided I'm going to watch the stock on the next day to see if it falls. Because the candlestick is red, it means the stock was falling on that day, so I shorted the stock here. Now the stock gradually dropped, and one day it hit my goal level, which was 72. But on that day, because the stock continued to fall, I got a bit lucky. It continued to fall, so I watched it until the stock price hit a support and began to move back up. And at that time I decided, okay, I'm going to exit my position. I wrote the word sold here because I was actually doing this with a put option. But I decided to exit my position, which means buy back the stock if you're playing stock, or sell the option if you're playing stock options. I decided to sell the option. If you'll notice, we bought it at about 78. Sorry, we shorted it at about 78. We bought it back at about 66. That's $12 per share if you're shorting the stock in terms of profit. So if you shorted 100 shares of this GBX stock, you'd have made $1,200 within about 2 weeks. Because I was playing options, I actually made quite a bit more. I don't play with large amounts of money. Instead, I use options to leverage small amounts of money to replicate playing with about 100 shares or 200 shares. I'm going to show you a statement from my brokerage. What we want to look at are the blue circles. If you'll see, the same GBX is the stock, and I spent $450 on a put option, which is essentially the same as shorting the stock. And if you go up to the next blue line, you will see what price I sold it at, which was $840, and then these are including commission. So I made about $800 from selling that. I bought it at $450, so I made a little under $400 on that trade. And that's pretty high ROI. That's nearly 100% ROI. You'll see another, this is actually from my newsletter, so I circled 2 of my trades, but this is another trade, another area gap trade, very similar. I bought a put, which is the same as shorting the stock, for about $300, and then I sold it for about $600, and that's a 104% ROI. This is not uncommon for gap trading, and it's an easy process. If you want to know more about gap trading, go to damonvario.com. When you get there, there will be a pop-up that asks you for your email. Just put in your email. I'm not going to spam you with anything. Just put in your email. I will send you a short guide on gap trading, which you can do yourself. Also, please subscribe to this channel because I'll be putting up more videos on gap trades. Thank you.